Rolling on episode 80, count it 80, of the Lone Star Capital podcast, which has gone through several name iterations, but the cast of people giving you the great information and knowledge will remain the same. Rob Beardsley, CEO and founder, with me today. I am Craig McGrouther, the Director of Business Development, Lone Star Capital, 700 million AUM, so on, so forth. We got a great episode today, but let's get direct to housekeeping because we want to keep this tight today. So we have our referral reward program. You've heard it once, you've heard it twice, you've heard it 1,000 times, but you're going to hear it again and again and again because we're going to bang this in your head. Referral reward program for a investor whom elects to invest with us that you send us, that we are not in contact with. We will pay you a nice fee of $2,000 on a one-time fee at closing of the deal. If you are a fund manager, capital allocator, or if you're anyone who knows of any capital raiser, fund manager, so on and so forth, who's looking to put equity in our deals, maybe you know other people. If you're a fund manager, you tend to know other fund managers. If you're an investor, you tend to know other investors. If you're a sponsor, you tend to know other sponsors, right? You see where I'm going with this. If you are a capital allocator, fund manager, you listen to the show, or maybe you're even a sponsor who thinks they could benefit from our services because perhaps you're in the Florida market and we're not directly competing with one another, and you want to send us a fund manager, at closing, if there is capital for us, we will pay you $5,000, flat fee, one-time fee. Okay, at closing. All right. Finally, 1031 exchange. The number is floating. Perhaps it's 10, perhaps it's 5. I don't know. Rob, I'm going to say it's 10 today. We're going to get in $10,000 for a 1031 exchange referral. Obviously, we would love that form of equity. It's a great form of equity. It's been a straw that stirs our drink with many of our capital raising endeavors. So we would love for those.
We've raised over 60 million in 1031 exchange funds.
Could you repeat that, please? Something was in my ear.
We raised over 60 million in 1031 exchange funds. So we are
6 million or 6D? 60?
60, and we have done it in various structures with various lenders. These are complex transactions. It requires all hands on deck. Dasha, our director of investor relations, does a fantastic job coordinating. Kent, my partner, formerly a tax attorney, does a great job working with our outside counsel, tax counsel, and real estate counsel to make sure that we're structuring everything properly with the 1031 exchange investor and with the lender and with us, of course. So I think if someone's thinking about 1031 exchanging into a syndicated deal structure, I think you would be hard-pressed to find a more caring and trusted home.
You would not want phantom income to arise, meaning you deferred, and all of a sudden you've deferred too much, and now all of a sudden you've got a massive bill coming your way. If you want to be a professional, you want to work with professionals. If you are a professional, be with the professionals. We are those people. We are in the One World Trade Center. Little known fact. Work with people who are sophisticated, smart, and savvy that will get the job done. Okay. And we'll tell you if it's a yes or a no, if it would work or if it's not. But we will be a good service and provider there. In fact, in correlation to Dasha Beardsley, our beloved Director of Investor Relations, a incredible person I get to collaborate with. She's the best, is actually perhaps writing a very, very significant ebook right now, or book pertaining to that whole process. And she may or may not be giving a speech at one of our events in the Bay Area that we're planning right now. So I don't know, maybe a little tickler there. But that said, referral reward program, if you need documentation on that, I will send you the PDF there, the doc there. So be happy to do that. On to the next action items here. We've got some really great events coming up that we're stoked on. It's kind of my Super Bowl because I get to set everything up, connect with everyone. I love meeting everyone in person. There's nothing like solidifying relationships, breaking bread, having a good time, a conference within the conference, if you will. We are hosting meetings at 2 events coming up. February 20th through 22nd will be Risefest. We will not be there on the 22nd, so it's going to be the 20th and 21st. If you're going to go and want to meet with us, those meeting slots will fill up quickly. It's only like, gosh, I don't know. It's not as many meetings as I'd think, so make sure to get time on our calendars there. And then also we'll be hosting dinners perhaps. So if you want to go to the fun stuff there, let us know. Similarly, Best Ever Conference, we'll be getting in there on March 2nd. And then the conference is the 3rd, the 4th, the 5th. We'll be leaving the 5th, as one does. So we'll be hosting conferences there. We would love to meet you in person. If you're a fund manager, capital allocator, got a 1031 exchange coming up, a limited partner, LP investor, we want to meet with you in person. So be on the lookout for that. And then we may or may not be hosting an event in the Bay Area that will be coming perhaps in the end of April. So be on the lookout for that. If you are naturally in the West Coast area, this should cater and accommodate to that. Did I miss anything else, Rob, pertaining to housekeeping there, or did I belt that out nicely?
I think that's good enough for now. Obviously, we have more fun things planned on the horizon, but for the next few months, just to reiterate, we'll be in Phoenix for Risefest, we'll be in Salt Lake City for Best Ever, and we'll be in the San Francisco Bay Area for our LSC Summit West. And regardless if you're planning on attending those events or not, if you are close to those areas and you do want to meet, reach out to us. We would love to connect with you. Love to see if it makes sense to, go golf, dinner, etc., whatever, so we can get some business done.
Absolutely. Cool. On to the show now, onto the agenda. Let's start, with the lead here. Today's a Thursday, January 30th. Yesterday, the Fed met, and there is no rate movement, so rates are staying steady. Rob, what say you on that subject? How do you kind of interpret that? What's your thought?
Yeah, basically, the Fed is feeling that the economic data is decent enough to where they don't need to keep cutting at the moment in order to help seal the deal on this soft landing. I don't necessarily disagree with their action because the market isn't throwing a panic or a tantrum over their actions, right? If they held rates steady, but the market is calling for rate cuts and freaking out, and you see the stock market crash, then you could maybe say, okay, well, they're kind of taking it to the limit. But right now, they're seeing that they're taking what the market's giving them. So it's unfortunate for us. I mean, we would like to see rates come down. I think a lot of people would like to see the short end of the curve come down and for sure the long end of the curve. But this is just the data that we have, and this is the Fed that we have. So at the moment, there's about a 26% chance of the Fed cutting in March. So that's not very good for those looking for a cut. But we'll see, because there's quite a lot of data coming out from today until that rate decision in March. So if the data is weaker, meaning job growth is weaker than expected, perhaps even negative, or inflation readings come back lower than expected, which is very possible as the lagging data that is housing continues to catch up and leak into CPI. It's very possible that percentage goes up. So yeah, I still think, I think I might have made a brazen comment on this show a month ago talking about how I think there's going to be 6 rate cuts in 2025. Maybe that was a little too ambitious, but I still think we're very much in store for at least 2 to 4 cuts this year still. And the people that are kind of thinking about rate hikes, I think that's crazy talk. So those are my takes.
If anything, I think it's just going to be sideways, not up, not down for the foreseeable. But I do think the general trend will be maybe to go down a touch. But as Chamath Palihapitiya on the All In podcast says, higher for longer. Would I be surprised? No, not necessarily, but we'll just see. And correct me if I'm wrong, but the important factual information is going to come out on Thursday and Friday. Obviously, today's Thursday, but you're listening to some Monday. But there's been a lot of the kind of the CPI kind of information, things that actually really dictate whether there should be a cut or not, actually, in fact, come out today and tomorrow.
Yeah, so there was some, it was funny timing about the
meeting.
I mean, it just is what it is, right? The Fed meetings are on Wednesday, and then we had some economic data coming out today. So I'm trying to see if there's anything. Anyway, I don't want to waste time trying to go.
I think it's coming out later today and tomorrow.
Right.
For the record, yeah.
Right. So anyway, well, those are my thoughts. Also, something that I wanted to mention early on in the show, since we talked about it at the end of last show, is our brand new fund manager toolkit. This is something, if anyone missed the back half of last week's show, this is something that I wanted to share kind of in the beginning of this show. We came out with this new fund manager toolkit. It's available for download on our website for free, of course. Just drop your email and we'll send you the whole package. In the package, we have our multifamily underwriting model, and then we also have the fund manager analysis module as well, which is basically something that you can use on top of any underwriting model, on top of any deal that you're looking at, and that will help you analyze what the compensation for you, the fund manager, is projected to look like, and what the projected returns are for your underlying LPs in your fund. And you can kind of basically run the whole dual waterfall through that analysis. And then obviously this is complex stuff. So I recorded a 30-minute video as a walkthrough, and that's included in this download package. So you can use that walkthrough video with the spreadsheets, and hopefully you find that resource very useful. If you have any further questions, or you want to have us look at a deal with you, it doesn't have to be our deal, just send us an email and we'd be happy to help you on that. So go ahead and check that download out. I just wanted to shout that out.
Who's going to be doing the walkthrough there?
You will, right?
No, I will not.
You're great with spreadsheets.
I will not. I will not be doing that, and you will not be doing that, and Brad will not be doing that. So I will not overpromise that. But yeah, download the guide. It could be helpful. Could not watch the module there. But that's.
I'll do it.
That is incredibly courteous. You are a gentleman and a scholar, if that's the case. So we're all going to hold you to it there. Otherwise, flame us in the comment section. Actually, like and comment, subscribe, right? We never say that, but it'd be cool if you did. But sorry, real quick, back to the rates section scenario. Rates, my opinion, I don't know. That's my opinion. No one knows. But what I do know is what is deflationary. All the supply coming online. Rents are really not growing anywhere. That is deflationary, right? In most instances, in oil and gas, electricity, energy is getting cheaper. Those are two things that are heavily deflationary. That should have a downward movement on rates at some point, but it's going to be a lot for it to get worked out. So yeah, that's kind of my 2 cents and takes there. On to the next subject, which I will screen share once more. We were having an interesting conversation about this, and this is a very unique dynamic in relation to just kind of the space and the industry of itself. J Parsons, by the way, if you're going to listen to another podcast, if you're looking to learn and touch more, the J Parsons Rent Roll podcast is spectacular. It is just nonstop good information. I was listening to some interesting kind of stats today. I was kind of at the gym listening to it, running. I was like, wait. I actually need to stop this and sit down and actually actively listen to this because it is such good information, just kind of topical facts, so on and so forth. But that's separate to this here, what I'm showing here. But what this is talking about is the fragmented nature of the multifamily apartment business. It's crazy, right? So if you go here, you look, the largest owner here is Progressive Residential for single family homes or single family rentals, which is 0.57%. The largest known apartment owner, Greystar, owns 0.47% of the nation's units, which is nothing if you think about it. If you think about like the Googles, the Metas, kind of more of the traditional stock companies, right? They own a disproportionate amount of the market share with whatever they're in. So seeing this is crazy. But Rob, I know you had some takes on it. You are also, I think, equally surprised. So we'd love for your take there.
Yeah, so I just pulled up the NMHC top 50 largest apartment owners, Greystar, which is usually around the top of the list, Greystar and MAA. They have 108,500 units. So that's a ton of units, right? Well, they literally have the most number of units of any owner in the country. And as you called out in Jay's post, what is it? They have 3.67% of the market. No, I'm reading the wrong thing. They have less than 50 basis points of the market share. So there is no monopoly. There is no oligopoly in real estate.
No price fixing or anything like that.
Well, the trappings associated with monopolies or oligopolies, seemingly don't exist if you have, the largest share being only 0.5%. So I think that's a really, really interesting thing because you look at industry these days, and a lot of industries have an oligopoly type of scenario where a few companies own all the market share. And in our business, that's simply not the case. So I think that's just a wonderful tailwind for us. I think it speaks to, as Jay says in the post, it's just the fragmented industry. Real estate's also a very slow moving beast for that matter. And it's also not very innovative because people kind of are existing in their own little worlds, and maybe a smaller time landlord owns a lot of properties in their particular market, and they don't really have those economies of scale. Another thought that I had about this is that it's really hard to have your brand goodwill extend at all beyond each individual property, right? Renters typically don't go from property to property and go, oh, well, that's a Greystar property.
Oh,
I
that's
like
Portland.
Greystar.
I'm brand loyal. There's no brand loyalty to apartment complexes. It's like, hey, what's the best deal right now in the marketplace? It's a bottom line business.
It's very tough business. There's a lot of turnover from a personnel perspective. There's a lot of turnover from your customer perspective because a lot of tenants bounce around, and the average turnover in our markets is around 50%. That means basically you lose half of your tenants every single year. I mean, that's not much better than a hotel. So it's a really tough business to actually kind of get those, not necessarily economies of scale, but like momentum and that goodwill, that brand, right? Everyone knows Coca-Cola. It's the most recognized brand in the world. And so you could be anywhere in the world and see, oh, Coca-Cola, I want to reach for that. But
iPhone,
how do
like the
you build that
iPhones. Yeah.
in multifamily? And
You
so,
don't. You
yeah,
don't. You have to
maybe,
be very competitive because it doesn't matter if it's our property, next property. A tenant's gonna look around and say, okay, well, they're offering me a TV as a concession. They're offering me 2 months free, or oh, well, they're $50 less a month. Yeah, I'm gonna go with the option that's $600 cheaper, right? It's common sense. I guess the only place where it starts to change is if you get to probably uber luxury niche rentals. Call it in like the Miamis of the world and New Yorks of the world, where you get to be in an area where it's highly premium. But guess what? Those things tank when the market changes, right? Those places tank when the economy is not, fine and dandy, right? So, there's very little kind of exclusivity and branding and stuff, it would seem, in the apartment space, which is kind of great for groups like us, right? And it's awesome because really, quite frankly, any group could be a massive owner here, and then what I highlighted here, and just section 4 of this, if you go to J Parsons post, which was posted on, let's see the date, if you want to go back to it, 3 days ago. So that would be on the 27th of January. Combining the top 50 apartment players owns, just under 11% of the market, according to the analyst for the data of National Multifamily Housing Council. That means small players control 89% of the market. Once more, small players control 89% of the market. That's mom and pops. That's groups like us. That's groups like maybe a Cortland, if you will, right?
Cortland's
Groups.
number 8 in the
Really?
country.
Okay, gotcha. So they're not consolidated with that group there, right?
Yeah.
But that said, that is just crazy to think that, really no one absolutely crushes and dominates the space. And I also think the market is designed where it's impossible to dominate the space like that, right? It's too difficult and too fractured for a reason, which creates, alpha and efficiency. Because guess what? If, let's say, a big behemoth, and I'm just actually thinking about this right now, if a big behemoth owned all these things, it would hold the line. They never sell. They'd have diamond hands, right? But you get opportunities when people who might not be the most sophisticated buy a couple apartment units, and that's extrapolated throughout the marketplace. All of a sudden, they bought at the bad time. They had the bad debt and equity structure. They can't pull lines of credit. They've got, liquidity crunches. They can't raise anymore. Well, guess what? That property goes under, and we have cycles resetting, so on and so forth, right? Which creates the opportunity in this space, which is why there actually probably is a skosh of alpha more in this than the typical, market beta, like a stock market S&P 500 plays, because over the course of time, enough players will get in there, they'll buy stuff, and maybe they'll do well. And then guess what? Everyone loses their shirt when the market shifts.
So I've got 3 points. So number 1, real estate, multifamily included, is really hard to manage. And it's particularly very hard to manage at scale. So the biggest owners in the country have 20,000, 40,000, 50,000, 100,000 units. And it's really, really tough. You're talking about having a workforce of 10,000 people. You have 10,000 employees at least. And so these are really people intensive businesses that are super hard to manage. So I think that's one of the barriers to being like a Google, where you have 80% market share in search or something like that, right? It's really, really hard because of the people side to really scale in this regard. So I think that's contributing to the fragmented aspect of the business. Another point that I have, going back to brand loyalty, is I think this concept speaks to why you don't see it being all that popular for properties to brand themselves with a consistent branding. Like Greystar doesn't name all of its properties Greystar on the rocks, Greystar at 7th, Greystar this, Greystar that, right? There's a few companies out there that do that, but it's not a typical thing to do. And I think that's why. And I think that is, people ask us, oh, well, why don't you name your properties, with like a consistent
Lone
name
Star, or this, that, or whatever it may be.
or
Well, it's kind of
whatever.
difficult. Yeah, it's difficult for the next owner to come in because now they have to change signage, they have to change this, they have to change
Yeah.
that.
So Cortland, to counter my point, Cortland is the number 8 largest owner in the country. They have 75,000 units, and they do actually name all their properties Cortland this, Cortland that. Cortland is a good operator. Cortland has a good name. I don't know how much really goodwill they actually can transfer over from property to property. Probably to some extent it does work, but that's a somewhat unique example where they do rebrand the properties. And we've purchased 3 properties from Cortland, and every time we have to spend, call it $40,000 to rebrand the property because the Cortland signage has to be removed and replaced. So anyway, not a huge deal, but I do think kind of in general, the branding thing is kind of played out, not that valuable, and has its risks because unless you nail it, then if you're managing kind of just a subpar average, then that's just going to actually cause harm to your brand across the board. And you get a bad reputation, kind of like how Tides has a pretty sullied reputation, not just in the private equity space, but in the actually tenant space, because Tides deals have been performing poorly and they're operated poorly and they have deferred maintenance and they all look the same and they're all named the same. And so
Colorway is like it's black trim and white apartments, which is obviously there's a reason. It's generally speaking a good look, but it's just exactly it's gonna be that property that ownership group. It's like clockwork.
Yeah. So my final point.
They might have bought all the white paint in America.
My final point about this market share topic is I think these numbers are going to grow. I think that people will figure out how to scale, how to, like Greystar or another company is going to go from 100,000 units to 200,000 units. That I think I see that direction. I see the business going in that direction. I don't think it's going to make a meaningful difference really, but I think it is to some extent a tide that is going to lift all boats. I think that fragmentation is a reflection of lack of sophistication, to lack of technology. But with technology, with the ability for people to be working remotely, to be able to train and manage remotely, it's easier for companies to have that scale. And you don't have to necessarily be boots on the ground landlord, mom and pop owner that lives on site at the property in one of the apartments, and then they rent out the other 20. Like, unfortunately, this is not necessarily a good thing, but I think unfortunately, whether it's smaller apartments that are 20 unit sizes or 400 unit apartments, I think more and more are going to be owned in some sort of professionally managed and ownership capacity rather than just small time landlords, mom and pop owners.
Interesting. Yeah. Well, we'll see if that prediction holds true or not. And one interesting thing I've also highlighted in the post was, let's be honest, in such an incredibly fragmented industry, it's massively harder for any one company with less than 1% market share to move the market in any meaningful way. Kind of an interesting thought, right? Let's say if you're, one of the big behemoths that owns X percentage, like the BlackRocks, and you kind of sell all of your stock, that obviously would, or a big position, that obviously is going to crater, the returns there and cause panic. And, I guess conversely, you can't move this market here due to that. And this market obviously is very darn efficient, which is cool. And then bottom here, we'll kind of end, I guess, with this, just kind of a pie chart just to show you apartments right here. Single family home rentals, a lot smaller. And I actually think that trend will continue to be smaller and actually, dare I say, shrink, because I remember during the height of everything crazy in my past life and career of selling homes, when I was doing that full time, interestingly enough, there's obviously the Zillows, the Open Doors, the BlackRocks. I mean, I was selling places like, hey, if it was a 4 or 5 cap, we'll buy it cash. It was the easiest deal ever. You put the house on the market and it would sell right away. Easiest thing ever. Not even inspections, no nothing, right? There was a lot of kind of hoopla and kind of fall cry over, big corporations owning these properties. So much so that a place like Texas did not allow any institutional owner to buy. So maybe it could be a single family, or I guess a family office if you will, a smaller kind of group, but you couldn't own over a certain number of homes there. So that will stay fractured. But apartments, I do feel like, to your point, if anything were to change and widen of the gap, it will in fact be apartments before single family homes, because the American dream, old adage, right, which is obviously shifting and changing. But that said, I don't think the single family home rental space will get larger, but conversely, as mentioned, final point, I think apartments will.
I totally disagree. I think that people are getting poorer, and there's the middle class is disappearing, and the dream of homeownership is largely unattainable for majority of people. So if you just trace incomes and average home prices, so average median household incomes and average home prices going back 100 years, it's a joke. It's laughable.
Yeah.
It's like you used to be able to buy a beachfront property in San Diego with what would be 3 times your income. Like, I don't even remember. I did this data. It's like 50 years ago or 70 years ago or something, like a house in San Diego was 15,000 and the average annual income was 6,000. Now that same house is 4 million and the average income is
at least
80,000. Right.
Well, I just think that legislation from a government perspective will come into play to block that. But I do think there'll be, smaller people that will own 100 homes, not as much, but we'll see. Time will tell. But I do think for sure apartments, that number will widen.
Yeah, I mean, apartments versus SFR for sure.
That's what I mean. Yeah, single families will be different than apartments,
but both will trend in the direction of. I mean, just to be cynical, we're trending, unless things change, we're trending in a direction of basically a few people at the top have all the money, and then everyone else is poor and owns nothing. Thanks, what's his name, Klaus Schwab or whatever, the World Economic Forum.
Really, you'll own nothing, right?
And be happy. Yeah, I think that's just unfortunately where a lot of things are headed, and so it's that does not bode well for the home ownership percentage for. But that chart is a little different than home ownership percentage, right? It's not home ownership versus rentership. It's of single family rentals, how many are owned by individuals versus large players, right? So it's a little bit different topic, but related.
Yeah. Well, embrace debate. We'll see what kind of goes. I mean, unfortunately, maybe I'm too optimistic and you're probably on the cynical side, and it probably pays to be cynical. But with that said, I mean, how do you hedge that then, right? Let's just go there. Like, if that's the direction, you and I aren't going to move the market. All we can do is get smart and be smart and educate people, if you will. That's redundant. All we can do, let me rephrase, all we can do is be ahead of the curve and try to get ahead of this. So if you are trying to get ahead of this, what do you do? How do you hedge for this? What do you do to counteract the inevitable then, and get your slice of it so you and your family is safe?
Yeah, that's a good question. Yeah. So, I mean, why is homeownership important, first of all?
Buy Bitcoin.
Yeah, Michael Saylor. So why is homeownership important? Homeownership is important because it is, for the vast majority of people, the number one path towards wealth. Most people own nothing. Like, they don't own any assets. And if someone does own an asset, it is their primary residence. It's their home. And so, yes, there's other ways to be wealthy. There's other ways to accumulate wealth. You can accumulate wealth without ever owning the home you live in. For example, you could rent where you live and then own 100 rental homes, and then it's the same concept, right? It's wealth either way. But for the average person buying a home with a mortgage, the reason why homeownership is so valuable is because it's historically been attainable. It makes sense. It's like, okay, I get to buy the asset, I get to live in the asset. Also, essentially, the government subsidizes and provides the world's best financing for these assets. So the returns on single family, you can't really compare apples to apples because they look really good, but they're actually more risky because it's fueled by more debt. So it's actually debt financed higher returns by buying why you should maybe buy a home instead of investing in the stock market. It's like, well, one is perhaps riskier because it's more levered, which is why you're seeing the better return. But anyway, those are just some of the factors of why it is attractive to own a home.
Also, just getting your fixed cost, right? It's kind of, it is in a sense, it's levered, and then it's also hedging against inflation to a certain extent. What do I mean? Well, if rent's going to keep clipping and clipping and growing and growing and growing, if you lock in your mortgage, I mean, the biggest winner, you could argue, one of the bigger winners would be anyone whom either acquired a house or refied their house at a point in which your debt is sub 4%, because we may never get those mortgages for a couple decades. We don't know what that looks like. That is very cheap. When I sold my house, bought my another one, I bought my house at a 6.85 rate. It is what it is. I've done very well in the house so far. I'm going to tear it down and do construction to it. But, that's not, that sexy of a rate. That's, more than triple on some homes that I've sold with some rates that my clients bought back then. Right. So just kind of fascinating there. But that is, a hedge against inflation to get your fixed costs kind of sorted out.
Yeah, for sure. Inflation benefits borrowers because you're
Correct.
paying back the debt in money that is worth less. So
Yeah,
if you,
can you expand on that real quick, just for just a good concept there? Like, the more money you borrow over the course of time, it obviously benefits. I mean, obviously it's pretty simple, but can you just expand on that just a touch more?
yeah, so if I borrow $1 million from you and there's rampant inflation over the 10-year period as I have that loan out, and then I pay you back the $1 million 10 years later, that $1 million, let's say when I borrowed it from that $1 million from you, let's say a Big Mac was $5. And then let's say 10 years later, that Big Mac is $10. Now I've paid you back in half as many Big Macs, right? Now you can buy half as many Big Macs with that same amount of money. So really dollars don't matter. It matters your purchasing power. So if I borrow basically, let's say 100 Big Macs from you and then pay you back 50 Big Macs, I basically, got to enjoy an extra 50 Big Macs all that time for 10 years while I was paying you interest. And as long as the interest costs are reasonable and I'm producing more income than the cost of the interest, then I'm winning in that scheme. So in an inflationary environment, particularly when asset values are going up, being a borrower is really attractive because you're able to borrow, and then the money that you pay back that you borrowed is worth less, and then all the while you borrowed that money to invest in an asset that went up in value. So that's kind of the perfect scenario that a lot of people have been able to enjoy since kind of the 80s, when we've been on a secular decline in interest rates, and we've pretty much seen call it a secular increase in asset prices. The question really is that going to continue? And nobody knows that. So yeah, we'll just have to see, right? We might be in a period of time, which Howard Marks, he's a pretty smart guy. He believes that we are in this next phase, perhaps the next 10 years or even longer, are in a more friendly environment for creditors or lenders rather than borrowers. So those situations could flip.
Yeah, without a doubt. Well, thank you for breaking that down. I just think it's a nice holistic topic. And for all those reasons, I put 5% down on my house for anyone who was not wondering at all. But I did lever it to the gills as much as possible. And I'm very happy about that. And I will probably do a refi in later this year. But, I wanted to put more money into arguably the best deal done in Lone Star history. Time will tell on that one, Cortland Copperleaf. Yeah, it was a good swing long trade there. That said, next topic, and we'll probably end with this one. And I know this might get heated. This might be, if you're a sponsor who
I
might
feel
be.
like we should save this for next time. It's too juicy, and
Are you happy with the length so far?
I'm pretty happy with the length.
I'm happy as well. Okay, well, you know what? We've got controversy coming next week, so you're not going to want to miss that one. In a world that is changing, in a world that's the constant evolution, let's just say this: be wise, be skeptical with maybe some who you choose to work with. We'll leave you there. For all those who listened this week, we appreciate you. For those who listen to our shows, we appreciate you. For those who know someone who might benefit from this content, these podcasts, please send it to them. We're not charging you. This is free. Our time is not, but we want to make sure that you get good information, you get good education. With that said, if you know someone looking to work with Lone Star Capital who could benefit from it, let us know. Send them my way. My email, once more, is Craig, Craig, @lscre.com. We would love to work with you. And any referral you may or may not have, once more, Craig at lscre.com. We will see you at Risefest. We will see you at Best Ever. We are setting meetings now. You don't want to miss out on those. For everyone listening, we appreciate you. Peace.